In the ever-evolving world of investing, there are concepts and terms that can sound quite unusual, even counterintuitive. One such term is negative stocks. What do we mean by negative stocks, and how do they fit into the broader landscape of financial markets? Before we delve into the world of negative stocks, it's essential to have a solid understanding of what stocks are and how they typically function. At its core, a stock represents ownership in a company. When you own a share of stock in a company, you have a claim on a portion of that company's assets and earnings. In traditional stock markets, stock prices tend to move in a particular direction upward. This upward movement is driven by various factors, including the company's performance, economic conditions, market sentiment, and investor expectations. Investors typically buy stocks with the hope that their value will increase over time, allowing them to sell the shares at a profit. Now, let's shift our focus to the anomaly in the world of stocks: negative stocks. At first glance, the idea of a negative stock price might seem perplexing. How can a stock have a negative value? To grasp this concept, we need to explore a unique set of circumstances that lead to negative stock prices. Negative stock prices are not the norm, and they are relatively rare. They typically occur in specific situations, often tied to extraordinary events or financial instruments. One way a stock's price can turn negative is through a reverse stock split. In a reverse split, a company reduces the number of outstanding shares by combining multiple shares into one. This process can lead to a higher individual share price, but it doesn't change the overall value of the investor's holdings. If a stock is trading at a low price before a reverse split, it may appear as a negative value per share afterward. Derivative securities, such as options and futures contracts, can also contribute to negative stock prices. These financial instruments derive their value from an underlying asset, which can be a stock. In certain scenarios, the pricing of these derivatives can lead to implied negative stock prices. However, it's important to note that this doesn't mean the actual stock is trading at a negative price on the open market. In cases of extreme financial distress, a company's stock price can plummet, approaching zero or even going negative in certain circumstances. While negative stock prices are not commonplace, there have been instances in history where they've made headlines. In the world of penny stocks, companies with low-priced shares occasionally execute reverse stock splits to meet listing requirements on stock exchanges. As a result, the individual stock price may briefly appear as a negative value after the split, even though the overall value of the investor's holdings remains unchanged. In April 2020, the price of crude oil futures contracts for the West Texas Intermediate (WTI) variety briefly went negative. This unprecedented event was driven by a combination of factors, including a significant drop in demand due to the COVID-19 pandemic and a lack of storage capacity for physical oil. Traders holding futures contracts faced the unusual situation of having to pay buyers to take oil off their hands. During the global financial crisis of 2008, Lehman Brothers, a prominent investment bank, faced severe financial distress. As the company's stock price tumbled, it approached zero, signifying the market's lack of confidence in the firm's ability to survive. While the stock didn't technically trade at a negative value, its near-zero price was indicative of the company's dire circumstances. Understanding negative stocks is crucial for investors, as they can have several implications. Negative stock prices are often associated with significant risk. When a stock's price approaches zero or goes negative, it may signal severe financial problems within the company. Investors should exercise caution when considering investments in such stocks and conduct thorough due diligence. Investors engaging in derivative markets, such as options and futures trading, should be aware of the potential for implied negative stock prices. This complexity underscores the need for a deep understanding of derivative instruments and their pricing mechanisms. Instances of negative stock prices, even if rare, can contribute to market volatility and uncertainty. Investors should be prepared for unusual market conditions and be aware that rapid price movements can occur, especially during times of crisis. In the world of investing, negative stocks are indeed a rarity, but they serve as a reminder of the complexity and unpredictability of financial markets. While encountering a negative stock price can be perplexing, understanding the underlying causes and implications is essential for informed investing. Investors should approach such situations with caution, conduct thorough research, and, when in doubt, seek guidance from financial professionals. Ultimately, the world of finance continues to present us with unique challenges and opportunities, and staying informed is the key to navigating it successfully.